Okay, welcome again. 1 minute past 5 in the UAE. Brent's nearly as high as the temperature is here in Dubai. $68.05 US waking up. Trump, China talks, are they agreed? It seems like the market thinks they are, so we're up $1.20 on Brent. But we're not here to talk about any oil. We're here to talk about the stuff and how it gets around on ships. So lots to get through. Question Q&A as always. Get your questions in. We'll run through as we're on the relevant slides. We've got some time at the end as well, hopefully. But look, I want to bring in Matt Wright, as our lead freight analyst. Lots to talk about in the tanker market. So look, I'll leave you in a very capable, big-brained hands of Matt Wright.
Cool. Thanks, Matt. Good afternoon, good morning, good evening. Thank you for joining us again for another Tankers webinar. Apologies, we have a lot to get through today. Don't want to sound like a school teacher, but it's going to be busy. But please do, as you're thinking of them, put your questions in the Q&A. We will aim to as many of them as we can by the end. If not, we will come back to you with an email, so don't worry about that. Great, let's get started. So, I think, as always, start with rates. Where are we in the market, and what do we think is going to happen over the next couple of months? So, as I said in February, for those of you who joined us there, rates were starting to sort of pick up compared with the earlier period in Q4, where we saw a real decline in rates over the whole of the second half of 2024. Over Q1, we saw that recovery. We have in the last month seen a bit of a blip, particularly on the dirty tanker side. VL rates have pulled off quite a lot, and the Aframaxes and Suezmaxes continue to fluctuate. On the clean side, on the LRs, that recovery has sort of stayed in, but is a little bit more unstable. But on the MRs, it really has just been more of the same. Very low, steady rates, not a lot of improvement there. However, we are starting to see more demand, which is very much needed on the MR side. Turning to the fundamentals, we'll get on some geopolitical factors that have been happening in the market, but just on the fundamentals, we are seeing a lot of that increase over Q1 was just more oil. We are seeing more crude, more refined products being shipped. You can see that in the chart on the left, both crude, DPP, and clean products. But as you can see from the far end of that chart, we saw a drop back in May, a bit in April and a bit in May. So there's a little bit of a waiver there. We're not seeing as much volume. We've seen a bit of a pullback in volume. On the crude side, most of that is in the West. We're seeing steady increases in the east of Suez, mainly the Mideast Gulf, in terms of crude liftings. And we're going to continue to see that growth over the summer. I will come on to later what our view is in terms of tanker demand related to OPEC production increases. But in the west of Suez, big increases. A lot of that was Kazakh CPC, but also US, West Africa, Brazil. There was big increases in exports across a number of regions. However, a little bit of a drop back in May, and that is sort of impacted tanker demand there. So moving on. I've been touching on the Suez Canal every single time, and I think mostly it's been more of the same, saying transits are low, we expect them to stay low. This time we've got a bit of a different story. We are seeing an increase in flows and transits in some cases. And I think we need to sort of take into account now that some owners are increasingly confident that they can make this. The situation in the Red Sea is safe enough. It is not across the board, and you can see the volumes, both east-west clean products, are still way down on where we were in 2023. But clean products from India to the Med and Europe have picked up, and that's mainly diesel. So that's hit on this chart here on the top right. And then we're also seeing a bit more Russian naphtha. And then on the crude side, very small compared to the volumes we saw previously, but we're seeing more Iraqi Basra taking the Suez Canal. And then the blue line here is mainly Russian, and that has been edging up, but that is much more seasonal based. So, and this is being reflected in outright transits. So I think that the message is clear. we are at the beginning of this process. This could all be undone if there are any more attacks in the Red Sea, absolutely. But it's the beginning of this slow and steady increase. It might take a whole another year, and there's going to be some owners that are going to stay away for a lot longer. But this is sort of the beginning. And you can see already the market that received the biggest boost from the effective closure of the Red Sea, the LR1s, the LR2s, carrying middle distillates from Mideast Gulf and India to Europe. That's where we're starting to see this big increase here. So there we are, we're definitely going to start losing ton miles in that market in the next couple of months. So definitely something to be aware of over the second half of this year. Now, another factor, sort of staying on the outside of the fundamentals, what's happening around the USTR port fees? So in our freight team here at Kepler, we had a look at this, and what we wanted to try and understand was, under the new rules that were clarified in April, what segments are most at risk to this? And we identified the VLCCs and the MRs as having the highest share based on 2024 volumes that were at risk of exposure to the US port fees. So in 2024, US imports and exports of crude and products, the chart on the top left is showing, VLCCs, Chinese owned and operated VLCCs accounted for over 20% of imports and exports. And then on the MR side, it was a bit lower at just under 15%. So they're the ones that we think are the ones that are most at risk. When you add on the number of sanctioned ships on top of this, for VLCCs, that takes effectively 30% of the entire VLCC market out of the US market. That is a pretty substantial volume. And then just to sort of clarify what the impact of the port fees would be from a monetary point of view, the chart on the bottom left shows the increases, for the VLCCs on, say, a US Gulf to China route would be close to $3 a barrel, which is more than a 50% increase based around current freight. And actually, we did this before the slump in rates, so it would be even greater than that at the moment. And for MRs, the other sector that we think is at risk, it's over 100% increase in freight. So a substantial increase, something that would be absolutely wanted to be avoided. So what is our view on the owners and operators? And I think fundamentally, while this is still a large percentage and based on 2024 volumes, we don't expect it to be a significant impact in the market. We think it will be more of a logistical constraint. And the reason for that is, for the VLCCs, while that is a large number of vessels in 2024 that would have fallen foul of this rule, we think there's enough capacity in the system to get past this, but also there's ways around it. For example, Chinese owned and operated VLCCs can avoid calling at the US ports and load crude cargoes via ship to ship. And what this would mean is, there's a huge amount of reverse lightering that goes on off the US Gulf as it is. They would just focus in on that trade. And then they would not, trigger the port fee. And actually, all of the other owners would then do the port loads. That's just a potential to help reduce the logistical issues. For the MRs, while it's a large number of ships, the MR fleet is so large, and there's so much ability to interchange these vessels. We think actually switching these out and having the Chinese owners and operators avoid this region would actually not be too much of a disruption. But it does mean for the Chinese owners and operators, they're going to be fundamentally less efficient operating in the Atlantic basin than a competitor who is not a Chinese owner or operator, right? They are not able to take advantage of the sort of normal triangulation that is very important in the market out there. Focusing on the Chinese built vessels, there's obviously a large number of carve-outs in terms of if it's a ballast, the voyage is under 2,000 nautical miles, or the cargo is 8,000 tons. But even then, we still found, looking at 2024 volumes, that about 10% of US crude imports would have fallen foul of this rule. This is mainly long-haul volumes on VLCC, the middle of LATAM, sort of outside of that 2,000 nautical mile limit. Again, definitely something that can be overcome. It's not prohibitive, but it's just reflective of how we're going to have to see some changes in practice. The fact that the US has essentially backed out the Venezuelan cargoes means it's going to have to look further afield for some of those heavy sours, those medium heavy grades. And as a result, you're going to introduce vessels that would fall under this. So again, there's going to be a little bit more thinking that has to go on in terms of if the US is bringing in more grades from outside of the 2,000 nautical mile limit, the ownership, whether it's Chinese built is going to be a little bit more of a problem to overcome. Right. So please, do get your questions in if you have any. We'll come to them at the end. Right, turning to the ton miles, right? So where are we at the moment? We saw a lot of growth. You can see that red line rising, pretty steadily from January through to April, but we've had a bit of a drop back. A lot of that is the US. We saw US volumes on on Aframaxes and VLs really pull back in May. And this is just symptomatic of lower exports. The balances in the US are much tighter and are expected to be over the summer. We are not seeing huge amounts of new exports from the US over the next couple of months. Some of the other things to highlight in the chart on the right, which is looking at April, May ton miles compared with a year ago, we're seeing obviously big Aframax volumes coming out of Canada for TMX. I'll come to that later. Brazil, that's going to be something that I'm going to keep hitting on this webinar. Brazil is a very, very important part of the VLCC market going forward, as is West Africa, Nigeria. The Russia, Kazakhstan, the growth in the Suezmaxes is CPC. That's something, again, that was a huge driver of the Suezmax market earlier this year. That growth is going to really fall away, not because of reduced exports, but because of the shorter voyages. And then the other thing is, look at those at the top: Saudi Arabia, US, Norway, Iraq, Iran, UAE, big VL exporters, and the volumes are really significantly down year on year. And that is that's something the market is still having to contend with. So turning to the OPEC story and where we see the market, the crude team here have revised down our price forecast for the remainder of this year. I think we're now saying closer to $57, $58 a barrel, $6 a barrel lower than our previous projection. So globally, crude condensate balances are going to average a surplus of nearly 600,000 barrels a day in 2025. This is up pretty significantly from where we were, what our view was even a month ago. The balances, the chart on the left, you can see even over the summer when we have peak demand, balances are only negative for a very, very brief period and not nowhere near as steep as they have been. And then come the end of the summer, we've got huge surpluses growing, and that is where it's going to start to become relevant for the tanker market. Focusing on the Middle East and excluding Iran. So here I want to focus on the commercial tanker market. Like, what is the opportunity here for particularly the VLCC players out of the Mideast Gulf? Essentially, as I just mentioned, growth in demand over the summer is going to keep the balances tight, but come late August, early September, those increased production out of from the OPEC Plus group and falling demand as cooling demand in those producing countries begins to decline, we're going to see this big blowout in terms of the gap. And late Q3 is when we expect to see exports really, really increase. Matt, I was literally just about to say your name.
I could
because I know you've been very heavily involved in this discussion and working closely with the crew team on this.
Yeah, look, it's a really interesting one. I think the story that the guys wrote last week, OPEC brings back more oil, but oil prices rise, was certainly one that people stood and took notice up of. And we've seen 800,000 barrels a day back from OPEC since their meeting in May. We see that staying the course that the group will take, more oil back in August. And if you look at structure on the Brent market, it's still heavily backwardated. It's not as heavily backwardated come Q4. And the reason is a lot of the OPEC barrels that are being bought back by the likes of Saudi, the UAE, and Iraq, um, they're going for direct crude burning for power generation. It's pretty hot here right now, as I mentioned at the start of the webinar. But a lot of that will go into the direct crude burn for these countries. When the weather starts cooling down, that will come back onto the market. So from a crude oil point of view, as we're talking here, while forecast drops off so dramatically in Q4, on a fundamental basis, is purely because the Middle East, the direct crude burn for power generation for air conditioning will drop off come Q4, and that's why you're seeing backwardation for say November December spread at 30 cents instead of 80 cents for August September. So it's one to watch. It's again for me though, and this is a common theme. It's a tariff story. If demand does come back because people are incentivized to start going out and buying more stuff because we've been in a pretty placid market for the first half of this year so far. If that confidence comes back and that ambiguity is waned because there is a trade deal, that could potentially usurp what our forecast says. But right now on the fundamentals, when oil comes back, Q4 is looking pretty grim.
Yeah, yeah. And I think, from a tanker market perspective, it's if OPEC continues, if OPEC goes past August with increased production, production coming back at a faster rate, do you think we're gonna flip to a contango, a steep contango, the kind that we saw a la 2020 when we had huge exports, floating storage, or do you think that actually going to be that they will pause cuts, which is currently our base case?
Well, yeah, I mean, look, that wasn't like a flipping structure. That was a bloodbath about 5 years ago. Negative oil prices, that steep contango. Look, at the end of the day, if there's a lot of oil around, the market needs the carry in it and the contango to make floating storage work, or even storage on land work, to cover the fees, because demand simply isn't there in the prompt month in cash. So, look, I think OPEC will do, and this is Matt's view, not the house view. Don't sue us, don't write in. But I think what the OPEC will do is try and bring it back as quick as they can when it's accepting to the market. Bear in mind that when the meeting happened for OPEC last Monday, market opened up $1.60 up because
Yeah.
the market priced in that was going to be more oil back than was originally thought of the 411. I think the group has done a fabulous job in managing expectations. And look at the world we live in when more oil back into a market is a good thing. So they
Yeah.
just need to manage it carefully. But Q4 looking really fragile.
Yeah, yeah, and I think exactly. I think the big point you made there is expectations. I think the proof will be in the pudding come August, September, when it won't be about expectations, it will be about real balances, and where we are at that time, and I think that's what will matter. And
Right.
and that kind of takes me on to the next chart, which is we this year, for the first time in the last few years since 22, we are seeing OPEC bringing back barrels at the same time, quite a lot of non-OPEC growth. This is Brazil, Guyana, Argentina. There is a lot of crude coming online that would otherwise, limit the amount that OPEC would be willing to sort of bring on. And that kind of takes me on to it's very much going to be a VLCC story here. So the Atlantic market has absorbed a large number of VLCCs over the last few years, and up until around April, May last year, essentially the Atlantic basin was able to absorb all new VLCC deliveries and keep rates pretty strong. Since then, it basically hasn't. And the fluctuations you see there in that west, that green bar, that green line at the bottom is essentially reflects volatility and demand for Atlantic basin grades. More recently, we saw a big spike in February, March when a lot of US crude went to Asia, but now that has since dropped back. And the chart on the right shows that it is really the US that is exposed to that volatility. In terms of the amount of VLCCs operating off West Africa or South America, they have declined a little bit recently, but fundamentally those numbers are much more stable. The volumes are actually a lot more stable as well. And it's the cargoes out of the US are the ones that we're starting to see coming under pressure, particularly as Brent Dubai widens and just that arb becomes fundamentally less attractive. The big story, I think, for the Atlantic Basin from now over the next couple of years is going to be Brazil. There's a huge amount. We had an FPSO come on recently. We got another one coming online. We also have Guyana coming online, Yellowtail coming online in Q3. But Brazil is really, from a VLCC perspective, is where the market is going to be in the next year. And the reason why this is interesting is, unlike with the US, where when the arb is closed, you really see those US barrels just stay in the west of Suez. Brazilian barrels are going to continue to move east and be competitive with the Middle East because of the nature of those crudes. They're more sort of medium heavies, barrels that are going to be attractive in Asia. Don't get me wrong, if we do see a huge supply glut coming out of the Middle East and OSPs are pulled lower and lower, it will make that long haul barrels, more tricky. But, as I said on the previous slide, the US has dominated the narrative in terms of VLs in the last few years. It is now going to be Brazil. That is going to be, we're already seeing in the last month, Brazil dominated VLCC demand growth in tunnels. And in terms of crude supply, that's where we're going to continue to see it. It's already just far less exposed in terms of flows to Asia Pacific. So that is going to be a big area to focus on.
Matt, I just want to add on to that Brazilian. We saw on our flows data that April came in at a record high in exports for Brazil, 2.1 million barrels a day. And if you go back to all the data that Kepler have, 2013, March 2013, that was 260,000 barrels a day. That is a 45-degree extrapolation. How much longer it will last? But yeah, look, in a world that seemingly needs more oil, Brazil have certainly stepped in.
Yeah, and you can see here for April, Brazilian exports to Asia Pacific exceeded the US for the first time in about 4 or 5 years. That, it flipped back again in May. But I think over the next year, that is going to be much more of the norm. We're going to see much more. And as a result, we're going to see VLCCs operating off South America in increasing numbers. Not necessarily we're going to see a big slump from the US, but it's not going to be the area of growth as we move to Brazil. Right, turning to CPC, and I saw we had a question on CPC come up, so hopefully I addressed that one here. So chart on the bottom left says Russian Federation. Apologies, should say Kazakhstan, because this is capturing volumes out of Novorossiysk, which is a Russian port, but it is the Kazakhstan CPC barrels. They are the ones, and it is this increase in Kaz volumes. They're producing way above their quota this year. And the reason why this is interesting for the Suezmax market is because these barrels came online March, April, when European refiners were in maintenance. So a huge volume of that increase went to Asia, specifically China, Korea, Japan. And to do this, it had to go out of the Med and around the Cape to Asia. It didn't take the Suez Canal, unlike Russian origin barrels. Voyage. It's a very, very long voyage, and we saw over this period around 40 Suezmaxes do this. So it's taking vessels not only on a long, huge ton miles, but it's also taking them out of the market for a very long period of time. And by taking them out of the market, what I mean is taking them out of the west of Suez, because you can see from the chart on the right, the Suezmax market is a west of Suez market and has been increasingly so over the last few years. As of early this year, 66% of all Suezmaxes were operating west of Suez. The remainder that is east is majority Mid-East Gulf, vanishingly few load opportunities east of Singapore. So what this did is it not only had a lot of ton miles, but we saw vessels pulled out. So you can see this. It was the lowest number of Suezmaxes in the West since sort of mid 2023. That really, helped support. That was a big part of the support that we saw to Suezmax rates in April, May. However, European refiners came back from maintenance and are now taking the vast majority of Kazakh CPC. And so the reduction in the ton miles is not because there's less, it's because there's less going to Asia. We got more just staying in the Med fundamentally. Some going to Northwest Europe, but the vast majority Black Sea Med. Incredible, much shorter voyage. And sort of turning to the other, the Suezmaxes this year, there is not the same strong demand for the market that we've seen, and we also now have a lot more deliveries. So we've got Suezmax deliveries really ramping up this year. A lot of them are trading clean on the first few cargoes, which I'm going to address in a little bit. But as I mentioned before, we've got tighter US balances. That was providing quite a lot of Suezmax demand earlier this year, but also we now have more VLs, with more switching to VLs from Brazil and Guyana, which is seasonal. Over the summer, we have VL loads, and over the winter, we have the Suezmax loads because of loading restrictions. There is a little bit more Suezmax activity out of the Mideast Gulf, but the majority of that is to India, very, very short voyage, and it's not really going to move the dial on that market. So we are, I wouldn't say bearish on the Suezmaxes, but there's not as much growth there in the near term. We do expect some trickle down from the Vs as they sort of hit that higher point in Q3. Moving on to Aframaxes. So Aframaxes, we had a very similar phenomenon where we saw the fleet dragged east, but for very different reasons. As I've discussed before, for anybody who's joined our webinars in February, a big part of this was the US sanctions in January. What happened is, the sanctions targeted 143 tankers that were related to Russian trade. There was a very, very high share of them. Over 60% of the vessels that loaded ESPO in 24 were impacted. Much, much lower impact for Urals in the West, under 20%. So what this meant was there was a vessel supply crisis for ESPO, and we saw a large number of vessels move east to do this. And you can see this here. So this chart is looking at of all the vessels that loaded ESPO between February and May this year, so after the US sanctions, and you can see their ton miles are predominantly Eastern Asia. So that's ESPO, just to be clear. What were they doing before? So what were the ton miles on those ships that have loaded ESPO? And you see actually majority were loading Northern Russian, so Primorsk, Ust-Luga, Urals, and a lot of Black Sea. So a huge, almost the majority of ships loading ESPO now were loading Urals this time last year. And that has resulted in this big spike. Literally from January 10th onwards, we have seen 50 plus Aframaxes now moving into the east of Suez. Another factor is TMX. This is less structural because a lot of these Aframaxes from Russia are staying east. They're doing Cosmino China. With TMX, this is West Coast Vancouver into Asia. Huge increase in Aframax ton miles. TMX is pumping more and more. We're getting more exports, and we're seeing a greater share moving on Aframaxes there. Some of this is obviously down to Pad 5, but you can see the Asia ton miles is really, and we're seeing more Aframaxes operating in the Pacific over the last couple of months compared with a year ago. So it's really, that is really starting to ramp up. The other thing that I think that's important to note with Aframaxes is Urals has been trading below the price cap. So since March, Urals dipped below that $60 per barrel range, and immediately we saw fresh vessels move into the Russian trade. These bars show the number of Aframaxes and Suezmaxes, or number of tankers moving into Russian trade for the first time in at least 12 months. So you can see in March, we saw 25 vessels that fell under that moving in. In April, it dropped down, and in May, it sort of evened off. The main reason for this is Russian freight rates are not what they were. I don't have the exact figures, but from Argus, you can see if you track their assessments of Russian freight, you've seen it has dropped back to sort of pre-January 10th, to around January 10th levels, both for Cosmino China, Black Sea India, Primorsk India, right? So they are, there is no greater, the incentive to move into that market between sort of January and April has really stopped now, which is reducing the incentive for vessels. But the takeaway from this and this is, you could say, well, this is just a Russian story. This is just reshuffling of ships to Russian business. It isn't quite. TMX obviously is separate. But here, this green area is all non-Russian, right? So when these vessels were in the West, they were doing some Russian cargo, but they were doing a lot of non-cargoes as well. And you've moved it all east. The utilization of vessels serving Russia is now much higher. And what that means is vessels were pulled out non-Russian market, and that is what supported rates. And again here, these vessels pulled out of the non-Russian market into the Russian market, pushing up freight rates for for commercial tankers. That has now slowed. So we're not seeing that incentive to move out of the commercial market. Again, now, with a slow, with the exception of TMX, not a lot of new growth in the Aframax market at the moment. Rates have come off. Right, clean. Like we saw on the dirty side, we saw a steady increase in ton miles, a little bit of a drop back in May, but not as big as it was on that. But the problem is we're still a lot of ton miles being moved on not conventional clean tankers. As we discussed in previous webinars, this big segment here is all Suezmax VLCCs trading dirty. Sorry, trading clean. So not of benefit to coated tankers. And then in terms of where we're seeing growth, it's almost all, we're looking at the top and the bottom 10, right? It's not the whole story, but these are the big movers. It's all loss. India, China, UAE, big MR markets are fundamentally down year on year. One of the biggest growth areas is US naphtha shipments on LR1s to Venezuela, which we know is not going to necessarily continue. So I wouldn't necessarily look at that as necessarily a good news story from the tanker demand. It has been a weak start to the year. However, there is definitely some strength coming through, particularly on the MRs. But as MRs, they continue to face competition from dirty tonnage. This is something that I'll continue to talk about until essentially, if the Red Sea remains effectively closed and traffic is low, this will be a problem. As soon as we see higher volumes through the Suez Canal, you won't see this happening. The incentive for Suezmaxes and VLCCs will diminish very quickly. This trend is not random. It is totally dependent on volatility in LR2 earnings, particularly in relation to Suezmaxes, which is this chart on the right. So just to explain what we're looking at, this is TD23, which is Mideast Gulf Med versus TC1, so Mideast Gulf Med crude, Suezmax versus TC1, Mideast Gulf Japan clean. And what we're showing here is what are in last year, earlier last year, TC1 was at a premium. So here you can see it was at TC3 with a discount to TC1. It then moved up, and it has essentially, the blue line here, it has essentially remained at a premium to TC1 since. And any brief period when it does dip below, you see a massive change in an increase in the number of Suezmax trades. That's going to continue. Every time you see a bit of a dip or it moves close, you see a corresponding spike. Essentially, and this is something I've been hammering home for the last couple of months, the Suezmax market is a ceiling to the LR2 market. There is another wrinkle to this, which is the large number of Suezmax deliveries this year and the number trading clean as their first 1, 2, or 3 cargoes. That changes the economics. Essentially, you get competition for free. Suezmax to trade in the clean market, they really do need to think through whether they want to spend the time out of the market, they want to spend the cost cleaning tanks. But when you've got a new build, you don't have that consideration. And you can see this year, sorry, apologies, the scale looks a bit odd, but essentially these are the build years, and it goes back 2003 through to 2025. And this is the trade year. So in 2024, there was a wide spread of what Suezmaxes were trading in the clean market. But in 2025, you can see over 20% of those vessels trading in the clean market are new builds. And that is going to continue because we've got more new builds coming online over the second half of the year. So, we should expect the LR's market to sort of continue to feel that competition, particularly if there's any strength in the LR market. The other thing to keep in mind is, as I've said, the Suezmax market has weakened. TD23 has been in decline for the last month or so, essentially steadily lowering that ceiling on TC1 and LR2s in general. And then more for the LR market and LR1s as well. The demand side there has been mixed. We're seeing lower westbound volumes. Part of the reason for this is there's just there's greater competition for diesel and jet into Europe at the moment. We've got, the US was in very, very deep maintenance we saw huge declines in exports over January, February, March. That has now come back, and as a result, there's much more diesel flowing into Europe, making those, the economics from India and the Middle East less attractive. So that is bit, and that's a big ton mile. It's a much bigger ton mile driver to go west than it is to go east. However, very strong naphtha flows into Asia at the moment. Really, really, the crackers there are pulling in a huge number of barrels. I think it will start to slow down soon, but that is sort of offset it for the time being. The other thing sort of supporting, from a demand side, it's pretty neutral. The other thing that is supporting is a reduction in supply. So the strong Aframax market we saw in April, May, meant we saw a big shift of the coated fleet moving from clean to dirty. And actually in May, it hit 57%, which is the highest, June, the highest share trading dirty since Kepler's been tracking this. Matt.
I mean, yeah, look, I want to touch on Europe and product demand because I think a lot of people have been surprised to the upside about how strong demand from Europe has been, actually.
Yeah.
Esteban, our sort of demand expert, wrote something on it yesterday that it's not China, it's not the US, it's not Southeast Asia that's seen the highest growth on quarter. It's been Europe, and we've upgraded. It was up 100,000 barrels a day for gasoline. Product demand growth for the continent. In a world that was looking to decarbonize, or arguably Europe was already going through it. The word of the first half of the year seems to be this recarbonization, that perhaps they were too far ahead of it. And one of the best performing parts of the barrel this year has been gas oil. Gas oil has been on an absolute tear. Structure, backwardation's the highest it's been since March. And it remains a very, very fragile environment. Only 2 years, Russia used to supply 50% of Europe's diesel. Now, we're looking at the US Gulf Coast, obviously like Middle East and West Coast Indian refiners took up the majority of the market share there. But, we're down today, and we're down today because of the BP refineries back in Rotterdam. But when you're talking about one refinery being a swing whether the market is up or down during the day, it's obviously going to have an effect on tanker freight coming from the AG or coming in from the US Gulf Coast. Europe remains incredibly fragile because it's such a big net importer now. It always has been, but
Yeah.
arguably with the shutting down of refineries, Grangemouth recently, you've got Gelsenkirchen coming in, that's going to shut down. And funding just not around for, you want to build a new refinery in Europe, forget it. You're never going to get a bank to agree to it. So Europe remains really fragile, but European product demand growth, I think, could really surprise the upside this year.
Yeah,
When we're going
exactly.
to come into seasonality Q4 for gas oil, I think you could see August, September looking quite good for MRs.
Yeah, and I think one of the questions was how much does declining demand in Northwest Europe offset declining the refinery closure, and what is the net short? Is the net short growing or is it stable? And actually, it's going to grow, right? Because of this, because we have it, we've got refineries closing. So that should, in theory, support more longer haul barrels. But at the moment, the US is just absolutely filling that gap. I'm going to come to that. The MR story is is very, very interesting because we've got so many conflicting narratives at the moment. So on the one side, you have supply. In terms of deliveries, in terms of supply growth, it is after a number of years of relatively low deliveries, it's really hitting its strides. We had 28 already delivered so far this year at least, and more to come over the next couple of years. That is sort of definitely keeping a foot on rates at the moment. If you look at where those MRs, so the chart in the middle looks at the MRs that have been delivered this year, where are they operating? So obviously, initially they're delivered in Asia and they're operating, but very quickly we've seen the majority now operating in the West. That was reflective of the fact that the West was a stronger demand side, particularly with Russian exports ramping back up, and particularly the US. That is now going to start to slow, and we're going to see more of those deliveries stay in Asia, and I'll come on to that. So we've got this supply side. The other thing I think that is not necessarily been discussed that much is this chart on the right, which is we have had a very, very high number of MRs in floating storage for over 15 days, which is pretty surprising. Nothing compared with 2020, but that was structural. That was price driven. This is not. This is very much to do with this is payment issues. So off Mozambique, we had a large number of MRs waiting to deliver, but because of payment issues, they were basically idled for a long period of time, way more than 15 days, some of them. Those payment issues are now being sorted, and so we're starting to see them come back. West Africa, a lot to do with the forex issues with the naira. That's so there's a few pockets. There's another off the north of the Suez Canal, a bunch of vessels that have been idled but laden for a long time. They are going to start coming back into the market. So we've got about 30 or 40 MRs that have been essentially held back. So that, this is tightened supply. So even at a point where rates have not been particularly strong, we had vessels removed. As these come back, this is like essentially like more supply hitting the market. It's definitely gonna, this is the problem that the MR market sort of needs to overcome this year. Now to the demand, um, Asia. The big problem has really been China. Ton miles out of Asia Pacific have been below or around about the 5-year average, really, really down on 23 and 2024. Initially, that was both China, Korea, but increasingly Korean volumes have come back. China's still really, really low, and a lot of that is to do with run rates, particularly the Shandong teapots, which are operating 40, 50%. Their utilization of export quotas is way, way down compared with previous years. And fundamentally, there's not a lot of incentive for them to be running higher. The margins are just very, very poor. So we're not necessarily expecting a huge change there. We did see a jump in ton miles, you can see over here in May, and that is to do with demand going into Pad 5. So refinery issues out of Pad 5 has pulled in a lot of, jet naturally is going in there, but increasingly gasoline. And actually, we've got 2 or 3 refineries due to be closed. Some of my colleagues have written very nice pieces explaining, the impact of regulatory issues in California. And essentially, that is now going to become almost like a structural flow for Asia Pacific barrels of gasoline, particularly in there. That is definitely a good news story from the MRs. I think the jet arb is pretty much closed, so we're not going to see a lot more going over at the moment. And the gasoline has slowed to an extent. But that's a new trade flow that is going it's going to over the next year.
Yeah, look, I just want to pick up on that because we like a good news story. There aren't many at the moment, so let's pick up on the ones that are good news stories. Look, just on this from an Asian gasoline planet's point of view, we wrote something yesterday. Ines, our colleague, does. She is our lead analyst on gasoline. We have Asian gasoline import demand at its lowest since COVID, which isn't a great story. But the irony is, if you're an Asian refiner in South Korea, maybe even in Singapore, that Pad 5 short into the US West Coast is a bit of a savior. Like you said, I think that it's a really important point because I think you're right that it is a structural flow. I don't think it's a short-term blip in trade patterns and trade flows. I think it goes back to my point I made around what's happening in Europe, very much in the US, especially California, where you've got the P66 refinery that's going to close down. Valero closing in the refinery. It will become a net import, and it's a difficult grade to blend to. It's a carbob grade. It's very low sulfur, and the octanes on it as well. They're difficult to blend to, and you can't blend in California. So I think that's a good news story. But once patterns settle down, will freight stay elevated? But I do think the Trans-Pacific arb is one to watch for people.
Yeah, 100%. And this is it's sort of hidden away, as you said, like gasoline demand, demand some of the Southeast Asian shorts, Indonesia, Vietnam, Philippines, there's just not been that. And part of the reason actually is we've seen, over the first quarter of the year, the first half of the year, refinery maintenance there was much lower than it has been historically. So it wasn't just a case of lower demand, it's just their they had lower import requirement.
Yeah, I think another good point there you made is that Indonesia, right? Indonesia buy 300,000 barrels a day of finished grade gasoline and gas oil. It's one of the biggest shorts in the region. And they came out
Yeah.
recently saying that They want to diversify their, who sells to them. They're buying power away from Singapore. Is that a tariff story? It's going to cost them more, but if in the grand scheme of things, tariffs are applied because they're not going to do as much business, say, with the US, you're running a balance sheet state oil company like Pertamina. It's a bigger picture thing. So I think that could be a good news story for MRs, maybe coming from West Coast India, the AG, because that Indonesian shore opens itself up. It won't just be a Singapore to Indonesian
Yeah.
complacent route.
Yeah. Right. One more slide. So the Western MR market. So actually ton miles here started sort of well below 2024 volumes, but have really ramped up quickly. And again, that's just reflective of the US and a little bit Russia, but very much in keeping with the fact that we're seeing huge increases in US exports. And that sort of May was the highest, it's the highest May on record, but 5-year average. We're not necessarily seeing that in rates, partly because, as we said, we're seeing a lot of those new deliveries being pumped into the west of Suez, sort of keeping that market depressed. But again, that is going to be, supporting from the Europe, less of a strong story. We did see an early and pretty strong start to the gasoline ARB season, where we saw, a big increase into Canada. I think they had a refinery issue there, so we saw a lot of gasoline going in there. And then just last week, EIA data came out, big increase in gasoline inventories, big decrease in sort of implied demand. And that has really sort of put a bit of a halt in terms of, even though the ARB is still relatively workable, it is not, we're not necessarily seeing strong flows there. And that sort of takes me to the chart on the right, which requires a little bit of unpacking, because what we're looking at here is we're comparing the spread between US Gulf and Europe, including Russia, the MR market, exports, and then the spread between TC14, which is US Gulf MRs, and TC2, Northwest Europe. And you can see there's a moderate correlation between the two. And essentially, earnings for TC2 have been higher than the US because exports from that region have been higher over almost all of this year. However, in May, US Gulf exports exceeded, and we now expect that earnings to start moving above. And what happens, the US Gulf is going to start to more like dominate proceedings when it comes to the MR market, as has been increasingly the case over the last few years when we see earnings more of a premium compared with historical periods where that was less common. So takeaway there is, as we're all aware, the US Gulf is a very much more important market there, and those earnings are going to move to a premium to TC2 in the next couple of months, I would expect. Right. I'm not going to read through all of this, but out, you get access to them, and anybody, and obviously anyone who's subscriber to Insight will be able to get them on the platform and watch a replay of this, should you wish to hear me speak anymore. But the main takeaway is, like, my bullish. This is over the second half of the year. The bullishness on VLCCs is, I will caveat that we will see exports grow in Q3, but be careful what you wish for, because this could be a bit of a boom and bust. Because once the market buys big, increases, we don't have growth in refinery runs forecast to be able to absorb that infinitely. So we will end up with a pullback potentially in Q1 26, where the market is able to sit back and consume inventories, particularly then if there's the flat price improves somewhat. So there could be a bit of I wouldn't say a boom and a bust, but definitely like a boom followed by a contraction on the VLCCs. That will the segments, but over the second half of the year, it's not that we're bearish on these segments, but there's not enough on the demand side to outweigh the supply side issues or the negative factors. So we're a bit more neutral on the other tanker segments. The MR market has improved significantly from just even a month or two ago. However, large fleet growth is going to continue to be a problem there. And with that, let's turn to some questions that come in.
Yeah, let's do that, mate. Should we? Okay, USTR. I think if you can go back to that slide, actually, mate. I don't think it was about number 3. Was it something like that? Any similar analysis from USTR slides for the Ships Act?
Yes, yeah. So we haven't got a slide on it, but I'll give you my takeaway on it. So the Ships Act sort of, it dovetails with USTR in that, but the SHIPS Act is very much about US ship building. So they want to build 250 ships, and they do actually mention tankers in there as well. And the way they want to do that is through essentially disincentive, they want to levy fees in another manner. This includes any sort of US flagged ship, if it's built or conducts maintenance even in China, there would be a fee. This has not become law. This is still being discussed. I think the main takeaway here is all of that will have a much smaller impact on the market as compared with USTR, which really does affect vessels on the water in a much more significant way. And I think that was sorry, I meant to mention this earlier. That's the main takeaway. The vessels on the water, this is from October, will be a big one. I saw there's actually another one around USTR after 14th of October on MR operated vessels by non-Chinese for import as well as export. So there won't be any fees. So if it's a non-Chinese owned and operated vessel, and it is even if it's Chinese built, there'll be no fees. And the reason for this is the carve out for cargo size essentially eliminates almost all clean cargoes. So if you have a Chinese built ship, but it is not owned and operated, an MR, then you've got no drama there.
Okay. It's amazing how ambiguous lots are. I mean,
Yeah,
you mentioned earlier on about, and Brent, just to see, Brent's still at around $68 a barrel, maybe 10 cents from where we opened up the webinar. So seems pretty steady after today's news. But you mentioned earlier on about that there was the refinery down in Canada. I mean, again, that was a tariff issue. I mean, there was a story on the BBC the other week about the amount of people going across from Ontario into Michigan, and traffic is down like 90%. It's simply that Canada are buying from elsewhere because of the tariff issues. They're not buying from the US, and vice versa. So it's a big loss that. So I think again that is a tariff story on the back of that.
yeah,
We had another question in the back of OPEC. Why is there such a significant lag between production increase and export increase? Look, this is a really good question because if you take face value and take the people who are trading Brent, vast majority don't know what an Incoterm is, and that's not a criticism. It's that they're not involved in the physical fundamentals of oil and how it ships. But look, Saudi and Iraq, they directly burn crude oil domestically for power generation instead of it reaching storage and then loads onto a ship. Right, this is why the oil is coming back right now, because the country can consume the product domestically. The one caveat I want to put in is that last year when we came out with our forecasts around what our view was about OPEC bringing back oil, we actually saw that Q4 was the right point for them, because that's when we see the US starting to plateau in terms of production. Norway, Guyana, Brazil. Look, I think we still have that view that Q4 should plateau, so non-OPEC supply does drop off, allowing OPEC to bring back oil. But they've accelerated that now in the face that there is a summer shortage in Europe. It's seasonal, but there is a summer shortage in the Middle East as well. And I think even the EIA came out yesterday and said that they see oil production in the US dropping off in 2026. So the patterns largely followed the course that we thought it would take, but the anomaly is the extra crude oil that Saudis and the Iraqis are allowed to produce, bear in mind some compensation cuts as well, will be consumed domestically for power generation instead of reaching the export market.
Yeah,
So a very good question.
absolutely, yeah. One other thing, just sort of address on the VL market, because I think there's the market at the moment has really dropped off, and I think it's sort of a bit confusing for some people. And we're like, well, we are seeing more volumes. I think there's sides to it. So just to address that, in the Mideast Gulf, we are seeing slightly higher exports, but we're seeing a big increase in vessel supply. In terms of the vessels, particularly prompt VLCCs in the Mideast Gulf, is sort of at at least a 6+ month high. And then in the US Gulf, while vessel supply there has dropped, export volumes have really dropped as well. So we're seeing both markets pulled down, but for very different reasons. This is, we always see a lull in VLCC rates And I think that's pretty much going to continue. But I think we will start to see a slow, steady creep ahead of that Q3 boom.
Yeah, no, I think the other consideration as well, because I think this came in last time that we had a freight webinar, is obviously the Ecozone in the Med. You know what that did for bunker fuel demand. I know bunker fuel, but it is going to be one of the stories to 2025. You know, high sulfur fuel oil markets are the strongest they've ever been. And you think about these new builds that you mentioned will be scrubber fitted, will want to run off high sulfur fuel oil. That end user cost needs to be considered. Gas oil again is strong. Everyone assumed that, and there was a structural shortage of marine gas oil in the bunker market in the Med when Ecozone came in on May 1st. But I think that's going to be one that a lot of people will watch. Owners, especially, I've had a few questions on it, and it wasn't a question, more a comment was about this. What about the high sulfur fuel oil market for new builds that are going to be scrubber fitted? It's going to be a consideration, I think, for the balance of the year.
Yeah, yeah, absolutely. I mean, I think that sort of brings us to the end there. So thank you very much, everybody, as usual. We'll make sure we try and send the slides out to everybody promptly. And we'll do another of these, I think, in October, beginning of Q4. But please, if you have any other questions, do email them in. But yeah, thanks very much.